Good morning. Welcome to the Absa Group Annual Financial Results Media Briefing. Our Chief Executive, Daniel Manele, and Financial Director, Jason Quinn, will comment on our performance, following which there will be a direct engagement with media. Daniel, over to you.
Thank you, Carly. Good morning, and thank you for joining us for Absa's 2020 Annual Results Media Presentation. We are presenting these results to you after a very difficult week for us, during which we lost and laid to rest Peter Matlari, our Deputy Group CEO. Peter was a valued member of our executive team and played a key role in overseeing our regional operations. Many of you paid tribute to him through your reporting in your respective media outlets, and I would like to thank you for that on behalf of Peter's family and Absa. I will briefly cover the 2020 operating environment and then share my thoughts on our performance during the past year. Thereafter, Jason will unpack our numbers, following which I'll update you on our refreshed strategy before we then both respond to any questions you may have. The COVID-19 pandemic upended the global economy in 2020, producing historic declines in economic activity across most countries. And coming into 2020, South Africa's economy was already in a mild recession following several years of disappointing growth, with high levels of unemployment, a weak fiscal position, and fragile business and consumer confidence. Real GDP shrank by 7% during 2020, well below the 0.9% growth we expected before the pandemic. In order to support the economy and ensure the orderly functioning of markets, the South African Reserve Bank instituted a number of measures, including reducing the policy rate by 300 basis points, purchasing government bonds, and providing targeted regulatory relief. Government also provided direct support to a large number of vulnerable households and to many businesses, which saw the fiscal deficit increase sharply. Growth in our markets outside of South Africa also slowed sharply, with weighted real GDP declining by 0.4%, significantly below the 5.7% growth we forecast a year ago. Against this backdrop, we demonstrated resilience in many areas last year. Firstly, I'm proud of our response to the COVID-19 pandemic and the operational and financial resilience of the business. Absa colleagues delivered exceptional support for our customers and clients under very challenging circumstances. At the onset of the crisis, our immediate priority was to keep our colleagues safe and healthy, and therefore we quickly switched to a predominantly remote working model, which our technology capabilities enable us to do relatively seamlessly. We ensured customer safety by putting in place various measures to ensure that our branches and ATMs were configured appropriately for social distancing. During South Africa's hard lockdown, over 40% of our branches stayed open to provide a wide range of banking services, including distributing social grants. We also gave our customers and clients considerable support on loans of 219 billion rands, which is 22% of our total group loans. In South Africa, we offered a very comprehensive relief program covering 613,000 of our retail and business banking customers. We also waived various transaction fees and provided insurance premium relief, while temporarily extending our credit cover to include a wider definition of loss of income events. Absa Regional Operations extended COVID-19 payment relief to over 61,000 retail and business banking customers. In our CIB business, we extended 54 billion rands in payment relief to clients across South Africa and ARA markets. We mobilized our citizenship program to support the communities in which we operate. Absa and its employees contributed 83 million rands to COVID-19 response initiatives across the continent, including donating over 3 million meals, to communities in need. We completed our separation from Barclays PLC successfully, on time, and over 1 billion rands below budget, despite COVID-19 lockdowns affecting some of our projects. The separation bolstered our skills in executing large projects, the value of which became evident in our COVID-19 pandemic response. Early in the year, we completed the rebranding of our remaining operations outside South Africa, and we're very pleased at how well the Absa brand has been received. I was fortunate to be able to join the rebranding celebrations in Kenya and in Ghana in February last year, just before the lockdowns began. We also completed a review of our group strategy last year, and I will say a little bit more about that later. Allow me then to turn to our performance during the past year. Our diluted normalized headline earnings per share decreased 51%, mainly as a result of significantly higher credit impairments, which almost trebled to 21 billion rands. This equates to our credit charge for the previous 3 years combined and highlights the extraordinary operating environment we had to deal with. Our return on equity fell noticeably to 7.2%, just over half of our cost of equity. Considering the unprecedented impact of COVID-19 and the related economic downturn, many aspects of our 2020 performance were resilient despite our earnings halving. First, we focused on protecting our balance sheet during the year, preserving capital and managing credit and liquidity risk. To that end, we felt it was appropriate to not declare any ordinary dividends for the 2020 financial year. We have decided to follow a balanced approach between retaining sufficient capital for growth, resuming dividends, and a period of capital accretion to build and then maintain capital reserves. The decline in our headline earnings masks several positive underlying trends within our results, which I think are worth highlighting. These include 2% growth in revenue to 81 billion rands, which was respectable given the substantial pressure on revenues in the financial services sector during the period, as COVID-19 lockdowns and the weak economy affected our ability to disburse loans, and transaction volumes also declined materially, particularly in the second quarter. Net interest income growth of 5% stands out, considering large policy rate cuts that reduced our net interest income by 3.7 billion rands in South Africa. Our operating expenses remain well managed, declining 2% to 46 billion, and our cost-to-income ratio improved noticeably to 56% from 58%. Our earnings and returns improved materially in the second half due to significantly lower credit impairments than during the first half. After falling 82% in the first half, our second half earnings were 19% lower year on year, and our return on equity improved to 12% in the second half from 3% in the first half of the year. Positively, our pre-provision profit grew 7% to 36 billion rands, our strongest growth since 2016 when we benefited from a material currency tailwind. Let me now hand you over to Jason to take you through our 2020 financial performance. Jason?
Well, thanks, Daniel, and good morning, everybody. As I look back, there were three very distinct periods in our 2020 results. Firstly, although our first quarter was somewhat impacted by COVID-19 in late March, revenue growth was high single digit with mid-teen growth in customer loans and deposits. Combined with continued cost management, this produced strong pre-provision profit growth. Credit impairments increased as we started to see the impact of COVID-19 only towards the end of that quarter. There was an abrupt change in the second quarter as our presence countries went into lockdown and their economies stalled. Loan production and transaction volumes slowed materially. Large policy rate cuts also reduced our net interest margin, despite protection from our structural hedge. In addition to slowing revenue, we increased credit impairments significantly, resulting in record first half credit impairments. As a result, our first half earnings fell 82%, despite fairly strong 9% higher pre-provision profits. In this environment, we prioritize protecting our balance sheet, including preserving capital and keeping a close eye on liquidity. Thirdly, although year-on-year revenue growth slowed slightly in the second half, our costs remained very well managed and credit impairments improved substantially. This all resulted in our second half earnings and returns improving significantly in the second half, as Daniel mentioned. All told, our normalized headline earnings fell 51% to 8 billion rand. Headline earnings declined across all three of our business units, primarily due to the substantial increase in credit impairments. However, it was encouraging that all the divisions grew pre-provision profits last year and that their second half earnings were far stronger. Normalized headline earnings in our retail and business banking, or RBB unit in South Africa, fell 55% year-on-year as 6% pre-provision profit growth largely cushioned far higher credit impairments. RBB South Africa's credit charge was more than double year-on-year, as we took large provisions against future expected credit impairments. RBB exited the fixing phase of its strategic journey with strong momentum, stability, and operational resilience as market share gains across all of its portfolios. It's now pivoting to the smart growth phase of its journey, aimed at building confidence and regaining leadership in the market. Normalized headline earnings in our corporate and investment banking unit, or CIB, fell 17%. Strong 22% pre-provision profit growth off a relatively low base was the main driver, while the business also took advantage of a conducive market environment. Investment banking and Absa Regional Operations unit was a standout, with earnings growing 11% off a high base. CIB's credit impairments were 6 times higher off a relatively low base. The large increase reflects single name charges and macroeconomic variable charges. And positively, CIB's revenue increased 14%, and the growth was broad-based, with markets, commercial property, and corporate banking all showing positive results. Earnings in our Arrow business unit, which comprises our operations in Africa outside of South Africa, fell 56% or 65% in constant currency. As with the other divisions, credit impairments dominated Arrow's performance, with charges 3 times higher year-on-year. Arrow's operating expenses grew 12%, also reflecting higher incremental running costs. Completing its separation from Barclays was a significant event for Arrow in 2020. In addition to the major rebrand that Daniel referred to, the separation also entailed the largest single data and systems migration in Africa, as customers in 9 countries were switched to a new enhanced online banking system. I'll now comment on key points in terms of customer loan growth. Entering 2020, the balance sheet momentum that we delivered over the last few years continued. National lockdowns reduced our loan production significantly in the second quarter, and loan growth also slowed in the second half, with gross lending ending the year 3% up. Retail and business banking South Africa, our largest book, grew 4% year-on-year to 552 billion rand, and our retail market share increased slightly to 22%. Corporate and investment banking gross loans rose 2%, and our Absa Regional Operations, or Arrow, loans decreased 1%. Looking at retail and business banking's loan growth in South Africa in more detail, home loans rose 5%, driven by strong production in the first quarter and in the second half. And our share of mortgage new business increased to 22% from 21%. It was encouraging to see the mortgage market recover strongly in the second half, with registrations up 27% year-on-year. Vehicle and asset finance grew 9%, improving our market share slightly to 22% as we gained share in both new and used segments. Our vehicle finance production also improved considerably in the second half, with particularly strong fourth quarter growth. Personal loans declined 1% as we tightened risk appetite in this area. Credit card grew 3%, and relationship banking was largely unchanged. Our deposit growth trends during the year were also quite different to loan growth. Deposits increased fairly consistently after the second quarter to end 15% higher year-on-year. Lower fees and commissions on the back of lockdown restrictions and the sharp reduction in economic activity reduced non-interest income. Overall, fee and commission income fell 9% for the year, and this decrease was partly offset by very strong performance in our global markets business. Looking at costs, operating expenses were well managed and responsive, declining 2% year-on-year. And this reduction reflects the benefits of our restructuring efforts over the past 2 years, particularly in retail and business banking in South Africa, and plus management actions in response to COVID-19 and lower variable costs as activity decreased due to national lockdowns. Daniel's touched on credit impairments of 21 billion rand, which was more than 2.5 times higher year-on-year, reflecting the significant strain on our customers and the impact of IFRS 9 accounting. Our credit loss ratio rose from 80 basis points to 192 basis points, which is above the global financial crisis levels we had of 175 basis points. We granted significant payment relief to customers in good standing who required short-term financial relief due to the COVID-19 pandemic. The relief portfolios were ring-fenced to ensure heightened monitoring when the relief expired. By year-end, the vast majority had expired, with Retail and Business Banking South Africa still providing payment relief on total exposures of just 1.6 billion rand. The payment relief portfolios performed in line with our expectations, with 92% of the portfolio up to date. Despite substantial payment relief measures, our delinquency profile and non-performing loans deteriorated. In the first half, our level of Stage 2 and Stage 3 loans increased materially. The second half uptick was less pronounced than we expected. And as we said throughout last year, we focused on preserving capital and liquidity and protecting our balance sheet and client franchise rather than growth during this period. Our group core equity tier 1 ratio decreased to 11.2%, although it remained within our board target range and comfortably above our regulatory requirements. Our liquidity position remained very strong throughout the year. Let me now turn to our outlook for 2021. There remains substantial uncertainty about the global economic outlook, and that depends on the rollout of effective vaccines and additional policy support. We forecast 3.1% growth in South Africa during 2021, although we only expect absolute GDP to recover to 2019 levels by 2024. The timely rollout of an appropriate vaccination program is critical. In any event, we think that unemployment and consumer spending will remain under pressure, and business confidence and investment is likely to recover slowly. Additional episodes of load shedding are likely this year, as are further waves of COVID-19 infections, with a particularly strong third wave expected right now in the second quarter. We think that the Reserve Bank will leave the repo rate unchanged this year, before increasing it by 75 basis points in 2022. We do expect our Arrow countries to recover faster than South Africa, with 4.5% GDP-weighted growth in 2021. Those countries that depend more on tourism, such as Seychelles, Mauritius, Botswana, are expected to recover slower than the more diversified East African ones. Policy rates are likely to rise during 2021, and public finances will remain a focus amongst policymakers in several countries. Based on these assumptions, and excluding further major unforeseen developments, our guidance for 2021 is as follows. On average, we expect the rand to be stronger in 2021, translating to a 2% to 3% growth headwind. We expect low to mid-single digit growth in net interest income, given improved customer loan growth. Although non-interest income growth is expected to improve, it's likely to remain low. We'll continue to manage operating expenses carefully, while maintaining investments in systems and digitization. We expect low single-digit cost growth overall. Our cost-income ratio is likely to be in line with last year's 56%, and thus we expect positive but slower pre-provision profit growth, particularly in the first half. After 2020 substantial build in coverage, credit impairments are expected to decrease substantially, particularly in the first half, resulting in an improved 2021 credit loss ratio. And consequently, we expect our return on equity to improve materially, particularly in the first half, to low double digits for the year. It's pleasing that our performance so far this year, including earnings, has been stronger than we expected. In line with our previous guidance, we did not declare any ordinary dividends for 2020. On our capital outlook and dividend policy, we'll follow a balanced approach between retaining sufficient capital for growth, resuming dividends and a period of capital accretion to build and then maintain a position of broadly the midpoint of our 11 to 12.5% CET1 target range. We expect to gradually resume paying dividends from interim 2021, starting with a dividend payout ratio of 30% and increasing to 50% over the medium term. In the absence of appropriate loan growth, we would return excess capital to shareholders, as we've done in the past. Thanks very much for your attention. I'll hand you back to Daniel now.
Thank you, Jason. Before we take your questions, let me update you on the strategy review that we completed last year and the context that informs the strategic decisions that we have taken. When I joined ABSA about a year ago, I'd agreed with the board that I would conduct an implementation review of the strategy that was adopted in 2018. It became very clear soon after the outbreak of COVID-19 that 2020 would be a year of tremendous change as the world grappled with the pandemic, which fundamentally was changing the way we work, the way we serve our customers, whose behavioral patterns, needs and expectations are changing rapidly. Over and above assessing performance gaps relative to our strategy, the review considered what we need to do to thrive as a business in a post-COVID world. The review concluded that while our strategic choices from the 2018 strategy remain relevant, the world in which we seek to achieve them has changed, and that some shifts and accelerations are required to ensure that we do not only maintain relevance, but are able to thrive and take advantage of the changes in the operating environment to advance as a business. The process then culminated in the refreshed strategy, and the refreshed strategy represents an evolution of the thinking that informed the 2018 strategy, which means that we will capitalize and build on those elements of our 2018 strategy that have been showing traction and complement them with insights that came out of the review process. And key to that is refining our go-to-market approach and executing with agility and speed, keeping the customer at the heart of everything we do. Another key feature of our refresh strategy is about us becoming more deliberate and more focused around our digital transformation, digitally enabling our customers and responding effectively to their heightened expectations for innovative, mobile and digital solutions that speak to their specific needs. To drive execution, we are evolving the 3 strategic priorities and 3 enablers that were pillars of our 2018 strategy into 4 strategic imperatives and 4 strategic enablers that will work in concert to deliver new and shared value going forward. The 4 strategic imperatives are: first, lead with purpose and deliver shared value to a broad range of stakeholders. Secondly, address customers' intrinsic needs throughout their life journey with differentiated customer propositions that are personalized and are delivered with a consistently high level of service quality in the right key moments. Thirdly, deliver propositions through a digital-first distribution channels that match and adapt to our customers' behavioral patterns as they evolve. And lastly, establish a diverse market footprint that best meets our customers' expectations. These will be supported by 4 strategic enablers, and those are: continuing to invest in strategic capabilities that drive market leadership. Secondly, to continue to build a modernized technology architecture that powers digital transformation. And thirdly, to evolve our execution model into one that drives fast lane innovation right across the group. And lastly, to develop and nurture the entrepreneurial mindset of our employees. Our refresh strategy better positions us to become a business that sustainably creates shared value, plays a meaningful role in our customers' and clients' life journeys, empowering them to achieve more and encouraging them to recommend us to family, friends, and business associates. Our refresh strategy also ensures that we have a relevant and competitive business model that will see us emerge from this crisis as a strong and resilient business for our colleagues, for our customers, clients, shareholders, and other stakeholders. I am proud of the fact that we have shown resilience through this crisis and emerged strong and well positioned for the future. Thank you for your attention.
Your hand by clicking on the hand button, and remember to unmute. You're welcome to switch on your camera while you ask a question if you'd like. We have media from several countries on the call this morning, so please introduce yourself and let us know which country you're in. We have a few questions already, so we're going to go to Nelly and Emma first, and then Londiwe, Isi, Njoko, and George will come to you after that. Nelly, can I ask you to go ahead?
My name is Nelly Brandt-Jonker. I'm from Netwerk 24 based in Cape Town. Could you perhaps comment on the reasons for the strong growth in deposits and how this compared to previous years? I also have other questions. I don't know if I should go ahead and also ask them now.
Nelly, if you could stick to one question for now, and then if there's time, so that everybody gets a chance, if you don't mind. Thank you. So, Emma, will go to you next.
Sure, thanks. Hi, this is Emma Rumney from Reuters, based in Joburg here. Thanks, guys, for doing the call. My question would be, you mentioned, Jason, and also in the statements and the presentation, that you would return excess capital to shareholders if loan growth wasn't adequate. Can you talk me through how you would intend to do that, and also what kind of level of loan growth there would have to be for that to happen? Thank you.
Okay, Daniel, I'll leave it to you to start.
Right, I can maybe start, and then Jason will I'm sure, add. I think the strong growth in deposits that we've seen would have been informed by sort of different aspects depending on which side of our business we're looking at. Given the reduced level of economic activity and reduced spending as such, you would expect to see sort of deposits accumulating, certainly in the retail side of the business. But as far as CIB is concerned, there was also strong accumulation of public sector deposits that we have seen. And Jason, I don't know if you want to comment on how that compares to the previous trends.
Yeah, thanks, Daniel. Thanks, Nelly, for the question. Look, I think the deposit growth really accelerated actually in the face of the crisis in the second quarter, and it stayed there throughout last year, and we've seen the same trends throughout the banking system. I think the driver is really around people and companies being quite defensive on managing their own balance sheets and cash flows. So for instance, we granted sector-leading payment relief. So almost 1 in 3 customers in our retail bank in mortgages took up payment relief, which meant that for 3 months they didn't have to make an installment on their mortgage. And much of that money actually stayed with the bank in the form of deposits, and much of it is still with us today. And similarly, in the corporate sector, many corporates are obviously very cautiously managing their liquidity and are doing so well, and are placing money with banks as a defensive approach now, while they consider their investment opportunities down the line. To Daniel's point, there's one fairly large account with us, which is the National Treasury account, which is awash with liquidity compared to prior years. And of course, we expect that to be fairly temporary in nature as it goes out as the Treasury disperses those funds into the real economy and into the various departments and the like. But Dan, I think that's that's the main.
Do you want to take the second question?
I'll take Emma then as well. Thanks, Emma, for the question around our dividend guidance, basically. Emma, what we said was that we wanted to take a balanced approach. Our key ratio to look at with respect to dividends would be the Common Equity Tier 1 ratio, where our board target range is 11 to 12.5. And when it's sitting at 11.2, of course, we didn't think it was right to declare a dividend. But we fully expect our 11.2 to grow during this year, quite strongly, in fact. And as we said, we've had a fairly good start to the year with respect to generating capital supply. With respect to more medium term, we then say, well, if we don't find the growth opportunities to invest our capital in. So, for instance, if loan growth stays very low, we would move quite swiftly to the top end of that board target range. And at the top end, I think you'd have to consider things more than just normal dividend flows. Emma, in terms of mechanism, we would look at a variety of mechanisms. We would consider either a special dividend or a share buyback at that point in time. Those would probably be the two preferred mechanisms that we would debate with some shareholders around what would be most efficient for them at the time. Thanks, Dan.
Thank you. Londiwe, could we have you next, followed by Isi and Joko?
Yes, thank you so much for the opportunity. Just one question on the growth of the home loan and the vehicle asset finance, 9% and 5%. That's quite huge, given that it was a volatile market, and analysts were warning that banks shouldn't be trying to grow their lending book at this point in time. Would you, as Absa, consider it to be aggressive, as maybe some may? And also in terms of the provisions that credit impairments of 20.6 billion, how much of that is attributable to the growing lending book as opposed to provisions because of COVID-19? Thank you.
Thanks, Londiwe. Isi and Joko?
Morning, and thanks for having us. Ebenezer from the Business and Financial Times in Accra, Ghana. So I'll be asking a country-specific question, if you don't mind. Really like to find out how Ghana's performance has been relative to the group, and also based off the budget reading on Friday, what your projections are for Absa Ghana for the year. Thank you.
I'll take that.
Thank you so much. I think Jason might be able to make a start at least.
Absolutely. Okay, with respect to the growth question, the home loans and vehicle and asset finance, and Dan, maybe I could make a few comments and then we hand over. Look, our growth has actually been very targeted. So if you go through the various asset classes in retail banking, in fact, we've reduced risk appetite for personal loans, and our market share is relatively low at 12%. So that's not contributing to the growth. Where we are growing has been very consistent with the strategies that we were busy with before the crisis hit us. So in home loans in particular, we built out far better relationships with mortgage originators. We'd invested in systems and technology, so our turnaround times were better. But the fact is, if you look at first-time home buyers, relatively young people, 35 years old and the like, and mortgages less than 3 million rand, there's actually a huge demand that's picked up there over the last year. And all we're doing is participating in that in the right way. We're comfortable with the risk profile. We're comfortable with the collateral. And in fact, the vintages that we wrote last year are performing very much in line with our expectations. Of course, we also price for risk, and that's part of our capital allocation decision making. It's quite similar in vehicle and asset finance, where our relationships with the dealer network and the like have improved a lot. Our turnaround times are excellent there. And we're comfortable with the asset class. So we believe that the new and used vehicle market actually recovered fairly quickly towards the end of last year. Had a very difficult second quarter, but by Q4 there was certainly a rebound, and we participated. But I don't want you to be left with the impression around aggressive stuff, because basically our flow of new business went from 21 to 22%, not a material shift. In vehicle and asset finance, it went from 20 to 22%. So, I think it's all appropriate growth from our perspective, and as stewards of the group capital, we're comfortable to allocate it to those businesses. Ebenezer, I'm going to help you as much as I can on this, but our Ghanaian business still has to print its results, so we're not going to go into tremendous detail there. You'll have a chance to meet those colleagues, Abner and others, when they do print their results. But from our side, I've been very pleased with our performance in Ghana. It's been a star throughout the crisis. It's proved to be very resilient, and its numbers are strong. I can't say more about the numbers today, and our team there will be meeting all of you fairly soon to do that.
Yeah, maybe just to add to that, as Jason would say, you'll get more details in due course. But in terms of the performance, of the Ghanaian economy, which is critical, of course, to how we then fare within that. Ghana has been only one of two of the countries in our portfolio which actually managed to deliver positive growth in 2020. So the overall environment has been rather strong there compared to the headwinds that they are facing, and Ghana has been the largest contributor in terms of earnings from as far as our countries outside South Africa is concerned. And so, as I said, from a point of view of what we are forecasting for growth in 2021, we're expecting the average of the Arrow countries to come in at 4.5%, and I expect that a significant contribution to that growth performance would be coming from Ghana.
Thank you very much. Next we have George, also from Ghana, and then we'll go back to second rounds, unless anybody new puts up their hand, which I don't see at the moment. So George, could you ask your question?
Can you hear me?
We can, George?
Can I go ahead?
Hi, you can go ahead, George. We can hear you.
Okay, so my next question is that going forward post COVID-19, would that change your growth strategy for the bank, and especially for Ghana? Are you going to?
Okay, George seems to have frozen. We did hear the first part of the question, George, which was, are we going to change our group strategy given the COVID pandemic? So Daniel did touch on that in commentary, but Daniel, perhaps if you can start with a recap, and perhaps by that time we can get George back on the line. George, I think what might help is if you switch off your camera, then we have a better chance of catching you. So Daniel, could you just recap on strategy?
Let me just talk. I think he was talking specifically to the strategy as it pertains to Ghana as such, but let me introduce that with an overarching comment to say that while in the wake of COVID, we have reprioritized to focus, as Jason was saying earlier, on capital preservation and managing our liquidity and credit risk have, if you wish, in a way, held in abeyance our growth strategies. Our longer term thinking is still very much determined by us wanting to deliver on our aspirations to be a leading bank on the continent. So from a point of view of the level of uncertainty that we're still dealing with at the moment, we would obviously combine that with a very pragmatic approach, which strikes a balance between, ensuring financial operational resilience, preserving capital, but also in a targeted way, pursuing growth. But if the opportunities as they continue to present themselves in Ghana continue in the manner that we had seen post-COVID, pre-COVID, and with the resilience that one has seen during the COVID period, I see no reason why we shouldn't want to continue participating in those opportunities.
Thank you, Daniel. I hope, George, that answered your question, but please put up your hand. I don't see you in the participants list at the moment, but if you rejoin, if you are on the line and can hear us, please do put up your hand again if you have a further part to that question. I think for the moment, Nelly, could we go back to you? You had some further questions?
Thank you. I want to know if you could explain the reduction in headcount and if this was due to retrenchments, and if you are considering further layoffs or retrenchments in this current year because of situation that we see in the economy.
Nelly, did you have any further questions? And then we can lump all of those together at the moment because there aren't many questions in the queue.
I'm just credit impairments better because I don't really see an explanation for it in the results. I don't know if I might be looking at the wrong. Sorry, I'm just looking for my question now. I didn't prepare for this round to ask it. I don't know if you maybe said something more, and I may have missed it, on if this credit payments are going to get worse in the coming months or in the next half year.
We'll take that.
And in which part of the market are you seeing the pressure on the consumer? Thank you.
Okay.
Okay.
Thank you, Nelly. I think, Daniel, if you could start on the headcount question, and perhaps Jason could elaborate on impairments.
Thanks, Carly. Nelly, in terms of reductions in headcount, we had a reduction of about 5% also across the group in headcount last year, which was around 1,075 people, of which 275 were due to retrenchments as part of restructuring activities that were ongoing. And the balance would be then sort of voluntary departures of people and natural attrition. And so from that perspective, nothing that was specifically COVID-related, but part and parcel of our evolution as and when we were restructuring our businesses.
Okay. Thanks, Nelly. Thanks, Daniel. On Nelly, on your impairment color that you're looking for, I think it's fair to say in the first half of last year, we built substantial what IFRS 9 calls macroeconomic variable provisions. We used to call these things general provisions. And that's really to look forward and to capture any losses that might materialize based on the economic scenarios that you determine at that point in time. So we used a fairly dire set of economic outlook indicators to build a substantial general provision. Now that general provision, now that it's on the balance sheet, will get utilized as and when any delinquencies or losses crystallize. We haven't released or utilized any of it yet in the second half, so it's substantially intact. So then the second half saw our bad debt provisions, at least in terms of loan losses, improve substantially, even better than we thought. And so our through the cycle guidance for credit loss ratio is 75 to 100 basis points. Of course, we printed 192 for the full year, but it was a lot better in the second half. First half was 270 odd. Second half came in just above that through the cycle sort of guidance. And so what we're guiding for 2021 and going forward is in fact that the worst of the bad debts are behind us, that we've got enough coverage to be able to deal with whatever risks manifest based on what we know today, and that the credit loss ratio will improve substantially in 2021.
Thanks, Nelly. Maybe just a footnote to the comments that I said earlier on retrenchments, just to add that typically that would be the last resort. Before we get to that, we will work with the affected colleagues to see if their skills could be utilized elsewhere in the organization, support them, give time to see if there are opportunities that they may want to pursue in the group, but the actual retrenchment as such would be the last resort after we have explored other avenues and supporting the colleagues actively also as part of their transitions into a retrenchment situation.
Thank you. George, I see you back on the line. Could we try you again? Just a reminder to unmute.
Apologies. Sorry for what happened. I'll quickly go ahead before I lose the line again. So my question was had to do with the fact that looking at how COVID has impacted on your operations, would it change your growth strategy going forward, especially for markets outside Ghana as well, and looking at your outside Ghana operations? So do you think that looking at how COVID has impacted on your operations, it might be a good time to turn to the capital markets to do some fundraising and giving part of your shares to the public reasonably, especially for the Ghana units.
Thank you, George. Daniel?
Thank you. I think, of course, COVID has brought about many changes in our operating environment. We are seeing the needs, the preferences, behavioral patterns of customers changing, how, where, and when they want to interact with us and how we need to serve them. Their worlds are becoming much more interconnected in terms of also migrating much faster into digital channels. Of course, as a business, we need to respond to that. We need to make sure that we respond to that at pace, anticipating some of their needs and making sure that we deliver to their very specific, personalized needs in that regard. So part of the strategy review was exactly about what I said earlier. How do we refine our go-to-market approach? How do we accelerate our ability to execute with agility and speed? And as I said, how do we create new value by solving for the specific needs that our customers need, which could include offering them solutions that go beyond traditional banking services and leverage alternative platforms, and which then also, for us as a business, would present opportunities for new tapping into new revenue streams, particularly fee-based income. The issue that you raised about the capital markets and I think the ownership structure of those businesses is an issue that we had been seized with before COVID, and is an issue once we see clear and the levels of uncertainty reduce, we'll continue exploring, and we know that's a matter that the authorities in your country have also raised with us previously.
Okay, thank you. The last question that we see in the queue at the moment is from you, Emma.
Great, thanks, Carly. Am I all right to ask for a couple as well?
Yes, please go ahead.
Cool, thank you. Thanks, guys. Firstly, Daniel, it'd be great to just get a bit more detail on your thoughts on the economic recovery. I mean, like other lenders, you guys have flagged how sort of dependent that is on things like the fiscal trajectory and vaccine rollout, but it would be good to get a sense of how optimistic you are that the government can deliver in those areas. And also, if you can say something about your outlook on jobs too, that would be great. Secondly, a bit of a follow-up to Nelly's question. You mentioned in the presentation at some point the sort of high cost-to-income ratio in the rest of Africa. I wondered if retrenchments and branch closures could be a way to pull that down. And just thirdly, if I can be cheeky, on lending, we've seen Absa pull back in some areas and build up in others, like home loans, perhaps taking a bit of share from peers who had cut back in those areas. And I just wonder, when the situation normalises, does Absa envisage a sort of big comeback in the areas where it has pulled back, and how will it deliver this in what's likely to be quite a competitive landscape? Thank you.
Jason, would you like to start?
Yeah, perhaps I could deal the lending question,
Yeah,
Daniel,
okay.
and then of course
That's
the economic
outlook.
and outlook would be for you. Thanks, Emma. So, look, obviously, as you say, very strategic and targeted growth for particular asset classes right now, which we think is appropriate. You're basically asking, if we saw normal times re-emerge, would we start lending in personal loans? Would we pick up, unsecured and these types of asset classes? And of course we would. One of the reasons we've been so balanced on our capital approach and not declaring a dividend right now is that we do believe there will be a recovery, and we do believe things will get better. And in a more conducive environment, we would continue the strategy that we paused, for instance, in personal loans that was giving effect prior to COVID. It is competitive, no doubt, and I've no doubt that others will look to that as well. I guess what might give us some confidence around that is that I think people and companies are managing their balance sheet, their personal affairs very, very carefully. And, I think if the virus and the vaccine all improve, there's a prospect for, maybe a slightly more kind of improving outlook. But at the moment, no. We think that it'll remain fairly intact in terms of our existing approach for the best part of this year. So you wouldn't expect us to re-enter the unsecured lending market right now in any way, shape, or form. We're quite deliberate and quite pointed in our targeted growth areas.
Thanks, Jason. In terms of the economic recovery, I think that's obviously a very pertinent question, given that our fortunes tend to be inextricably linked with those of the economies in which we operate. I indicated earlier that we are seeing a recovery in South Africa, a partial recovery from the very deep contraction of 7% of around 3%, just over 3%. And we are expecting growth in our Arrow countries from the 0.4 contraction outcome for 2020 to a recovery of 4.5% in 2021. But I do have to add that these forecasts continue to be characterized by a high level of uncertainty. It is really a question of who wins the race, really. It's the race between the vaccines and the virus in terms of how quickly the vaccines that clearly harbor lots of hope can be rolled out efficiently and effectively, how some of the logistical arrangements can be overcome to make sure that mass vaccination programs get implemented as quickly as possible. As far as South Africa is concerned, as you are aware, we went into the lockdown and COVID-related challenges already with a relatively weak macro position in South Africa. So some of those issues that were with us previously would need to be still attended to in terms of making sure that we improve on our fiscal position, making sure that necessary structural reforms get implemented, and that we see progress being made in that regard to help us coming through. But overall, we are optimistic that going forward, we will see the recovery taking hold. And in fact, already what we have been seeing into the third quarter and the fourth quarter of last year and the opening months of this year is a recovery that is somewhat stronger than had been anticipated. But I would preface that with what I've just said now, that there are high levels of uncertainty that are attached to any of these forecasts that we're making. And of course, that then has implications for the outlook for jobs, and which are obviously linked to the growth dynamics that one would see.
Thank you. There are no further questions in the queue at this point, so we'll conclude. Thank you very much, everybody, for joining.